When the ETFs were getting approved, everyone was focused on that milestone, which was certainly significant. However, what wasn't getting as much attention was that on the same day, January 10th, the CME also approved a range of new futures contracts. The issue with futures contracts is that they can introduce a lot of complexity and risk. Unlike spot markets where you directly buy or sell the asset, futures involve agreements to buy or sell an asset at a future date for a predetermined price. This can lead to increased volatility and potential for large swings in price, as traders can leverage their positions significantly. Futures contracts can impact the underlying asset's price through speculative trading and market manipulation. This complexity can sometimes overshadow the positive effects of ETF approvals, as the introduction of these new futures contracts could lead to increased volatility in the market, potentially affecting the stability and pricing of the underlying assets, including Bitcoin. So, while the ETF approval was a big step forward, the concurrent approval of these futures contracts warrants close attention due to their potential impact on market dynamics.
While the approval of ETFs was a major focus, and certainly a significant development, it's crucial to recognize that on the same day, January 10th, the CME also approved a wide range of new futures contracts. This aspect didn't receive as much attention but is equally important. The problem with futures contracts lies in their complexity and the potential risks they introduce. Unlike spot markets, where you directly buy or sell an asset, futures contracts are agreements to buy or sell an asset at a predetermined price on a future date. This introduces leverage, which can amplify both gains and losses. As a result, futures markets can experience increased volatility, with prices swinging dramatically due to speculative trading and market manipulation. The introduction of new futures contracts can impact the underlying asset's price. In the case of Bitcoin, for example, this could lead to greater price fluctuations and potential instability. Speculators using futures might drive prices up or down in ways that don't necessarily reflect the asset's fundamental value, adding an extra layer of complexity to the market. So while ETF approvals represent a positive step towards broader acceptance and mainstream integration of assets like Bitcoin, the concurrent approval of new futures contracts could introduce new dynamics that impact market stability and pricing. Investors should be aware of how these futures contracts might affect the market and consider this complexity when assessing the overall impact of these developments on the asset class.
Subscribe our channel and press the bell button to get our video notification. And like the video.
There's been $300 billion in asset flows into Bitcoin, which is just a small fraction, about 1% of the $30 trillion in assets out there. This indicates that we're still far from seeing the full potential of institutional investment in Bitcoin. The large numbers we're seeing now, particularly with major players like BlackRock, Millennium, Citadel, and various sovereign wealth funds, reflect significant structured trades. These firms are employing strategies where they go long on the ETF and short on the futures, effectively arbitraging the spread between the two. This spread used to be as high as 30% during brief periods, but has since narrowed to around 10% and possibly even lower. For this arbitrage opportunity to be attractive, the spread needs to fall below the cost of funding. Once that happens, the incentive to engage in these trades will diminish. While short-term flows might appear weak under these conditions, it's important to remember that there will be genuine investment flows. Investors will start to buy Bitcoin and lock it up, using it as a diversifying asset in their traditional portfolios.
There's been $300 billion in asset flows into Bitcoin, which represents just about 1% of the $30 trillion in total assets available in the market. This suggests that we are still far from reaching the full potential of institutional investment in Bitcoin. What's noteworthy right now is the involvement of major financial players like BlackRock, Millennium, Citadel, and various sovereign wealth funds. These institutions are executing sophisticated trades. where they go long on Bitcoin ETFs while shorting futures contracts to arbitrage the price spread between the two. In the past, this spread was as high as 30% during brief periods, but it has since narrowed to around 10%, and possibly even into high single digits. For these trades to be profitable, the spread needs to fall below the cost of funding. Once the spread reaches this level, the incentive to engage in these arbitrage strategies will diminish. While this might make the immediate asset flows look weaker, it's important to understand that this doesn't reflect the overall investment interest. In reality, as the spread narrows and the arbitrage trades become less attractive, we can expect to see more genuine investment flows into Bitcoin. Investors will be buying Bitcoin to hold and use it as a diversifying asset within their traditional portfolios. This transition is crucial for Bitcoin's long-term integration into mainstream financial markets. It signifies a shift from speculative trading to serious investment, where Bitcoin is recognized for its role as a diversifying asset. As more institutional and individual investors lock up Bitcoin and include it in their portfolios, it will further validate its place in the financial ecosystem, ultimately driving greater adoption and stability in the market.
The key point here is that Bitcoin itself doesn't change. One Bitcoin is always one Bitcoin. What actually affects its value is the currency in which it's denominated: dollars, yen, euros, etc. If all fiat currencies stop printing money, Bitcoin's price wouldn't necessarily rise based on its own merit. Instead, any changes in its price would be driven by supply and demand dynamics in the market. The rise in value of assets like Bitcoin, gold, or real estate isn't a T due to these assets improving. Rather, it's because the value of money is declining. As fiat currencies lose purchasing power due to inflation or increased money supply, these assets appear to gain value as they serve as stores of value. I also wanted to mention a great follow on Twitter, Super70s. He's a bit younger than me, but shares a lot of nostalgic content, from Slurpee cups to baseball memories. His posts often remind me of how our experiences and the value of things can change over time, much like how we perceive the value of assets like Bitcoin in the context of a changing monetary system.
The key thing to understand about Bitcoin is that its intrinsic value doesn't change. One Bitcoin is always one Bitcoin. What really impacts Bitcoin's price is the currency it's measured against, such as dollars, yen, or euros. If all fiat currencies were to stop printing more money, Bitcoin wouldn't necessarily increase in value on its own. Instead, any price movement would be driven by the dynamics of supply and demand among buyers and sellers. The reason assets like Bitcoin, gold, and real estate often appear to rise in value is not because they are inherently improving, but because the value of the money used to denominate them is declining. When fiat currencies experience inflation or lose purchasing power due to excessive money printing, assets that serve as stores of value, like Bitcoin and gold, tend to increase in price. This is a reflection of the weakening of the fiat currency rather than an improvement in the assets themselves. I wanted to mention Super70s, a great Twitter account that shares nostalgic content. Although he's a bit younger than me, he posts about everything from Slurpee cups to baseball memories. His content often highlights how our perceptions and experiences shift over time, similar to how we view the value of assets like Bitcoin as the monetary landscape evolves. It's a reminder that as our environment and currency systems change, so too does our understanding of value and investment.
Subscribe our channel and press the bell button to get our video notification. And like the video.